Hey, Bowtie Nation, Joseph Hogue here. Thank you for joining us for another one of these live stream Sundays, Beer Money Sunday as it is. I'm actually doing the coffee for this weekend, but don't let that stop you. Feel free to have your favorite adult beverage there or whatever you're drinking out there in the Bowtie Nation. Got a great video planned for you today. Thanks for being here again. I love doing these live streams. Just a way to just kind of connect to you a little bit more face to face, a little bit more informal. Get to take off the bow tie and talk about what we're seeing in the markets and some of our favorite trends. Already see a lot of members out there in the bow tie nation there. Germany, a lot of people from Florida, Cocoa Beach, Melbourne, Colorado, Miami. Great seeing you there. Thank you for being here again. Love this kind of face-to-face interaction we can get every Sunday. This week been following a trend or a sector really for almost about 4 or 5 months here, really waiting for this thing to take off. And I really think it can be one of your best opportunities for the rest of 2021, especially through the summer. All of you out there in the nation know that we've been following, we kind of front loaded our Bowtie Nation portfolio in financials and energy stocks back in October, November. That's helped the portfolio produce a 35% return so far. It's beating the market by about 30% so far this year. But I think we're going to see a shift here into the summer and through the rest of the year into the sector that I want to talk about today. And the reason why I'd start at that sector level and we'll kind of work down from there into the stocks to pick and the stocks to buy for the rest of the year is it's so much easier than just trying to start with 5,000 stocks, right? 5,000 stocks listed on the U.S. exchanges or, the thousands on really any exchange wherever you're at in the world. You can't just start with thousands of stocks and try to find your way around. Okay, you've got to start with those broader macroeconomic trends or those broader trends in the market. Find the stocks that are going to benefit from that, whether it's a current trend or something that's going to play out over the next decade or decades or more, even with some of those big trends that we've been following. So you start with those bigger trends that are going to benefit every stock in that sector. That narrows your list down right there into, maybe a few hundred stocks at the most, or even less than 1,000. So you just start to narrow your list down. You find, and then really it's just a matter of finding the best of the breed in those sectors or in those groups of stocks, those themes. Okay, and the beauty of this is not only does it make your job analyzing and picking the best stocks easier, but you really don't even have to be right, right? If you find these sector trends, these economic trends, these broad multi-decade trends, then that's going to benefit all the stocks in that group. So, you might pick the second or the third best in that group, as it were, and still do very well because all those stocks in that group are going to benefit. We're going to be talking about a little bit, short, nearer term trend today, something that we're looking at for the rest of the year. And so I'm excited to get started on that. Before we do get started, I want to invite you to download a free report, something I've started up with the Motley Fool. Limited time. It's only going to be for about another couple of weeks that we're going to have this available. But it's the 5 stocks that are the biggest stocks in my own portfolio. Realized after we did that Big Trends investing series on the channel that I didn't share, the 5 stocks over all these trends that I'm watching, these multi-decade trends like AI, robotics, self-driving cars, things like that. So I wanted to do one inclusive report, 5 stocks. They're actually the 5 biggest stocks in my portfolio that I'm investing in for the next 10 or 20 years even. So I've left a link actually in the chat, pinned it to the top of the chat, as well as the video description below if you want to download that. It's completely free. Motley Fool is going to send you a few emails. You're under no obligation. I actually do use the Stock Advisor program on Motley Fool. It's got some great analysis with it, but no obligation, totally free report. Just, go ahead and download that. I appreciate it because it helps support the channel as well. But I want to get started here because I want to talk about the, this trend that I'm following or the sector that I'm really expecting to do well over the next few weeks. If you didn't catch it, last week's videos, we had a really good video Wednesday on the highest return monthly dividends. Check that out. We've been doing a lot of monthly dividend stocks over the past month or two. We did the stocks that I actually use to pay my rent. It's about 7 stocks that have monthly dividends come out. We did the highest yielding stocks, but then I wanted to do one where it's the highest return, because I know a lot of investors out there, they see those monthly dividend stocks, they see those monthly dividend funds, or just the high yield stocks, and they get dollar signs in their eyes, right? They go after the highest yield they can find, 15, 20, 25%. And it ends up losing them money, right? Because a lot of these high yield stocks, these 15, 20, 25% yield stocks just can't support that kind of a dividend, right? Or it's just because the stock price has come down so much. So what's more important is that you look at that total return, the share price plus the dividend yield return, and pick your stocks from that. So we did a video on that on Wednesday. Make sure you check that out. Next week, we've got some forever stocks coming up. 5 stocks that are a part of my portfolio for the next 10 or 20 years. A lot like that free report that I'm offering through the link there. It's just kind of a 5 more stocks that I'm holding for at least 10 years. Stocks that I think are on that next wave of technological revolutions or those big themes that we're looking at. So make sure you check those out. But now I want to get to the topic of the week, because this is something that I've been watching for a few months now, trying to waiting to see it really play out, and it's already played out to a point. What we're talking about here is the consumer discretionary stocks, right? So all that stuff that you buy that maybe you don't necessarily need, right? Or maybe you spend more on than you really need to. All the companies that make those kinds of things. So we're talking apparel, we're talking everything in the retail space, we're talking even automakers are within that consumer discretionary sector. And we'll look at kind of the industries as well as the stocks in there. But right now, I just want to start off with looking at the chart here. This is the XLY, right? The XLY, the Spider Consumer Discretionary ETF, right? It's a exchange traded fund that tracks this sector. In blue here, in red is the S&P 500, so that broader index. And you can see here, I've noted in green, here is the green arrows note where the consumer discretionary sector kind of started outperforming the S&P 500, right? So you see that gap expand from the blue line and the red line. The red arrows down are where the sector started underperforming the S&P 500, okay? So you see, even as early as August of last year, really, when we started to get optimistic about the next year, about 2021, and about moving on from the pandemic and reopening instead, then the consumer discretionary stocks started doing better, right? They lagged obviously in the lockdowns because no one was out spending at those traditional retailers. So the consumer discretionary sector did really well. Then in March, we started seeing higher rates, higher interest rates kind of spooked the market, those interest rates, because a lot of these stocks, the earnings just hadn't rebounded yet, so they were still a little bit riskier. So a lot of the market was looking at higher rates, maybe slowing down the economic growth and that kind of thing. So they came down. COVID lockdowns came back in Europe and other parts of the world there in March. So that's why you saw a lot of those consumer discretionary stocks sell off and underperform the market. Just recently here in April, of course, things started getting back up with some really strong consumer spending numbers. We got those 2 rounds of stimulus checks that went out and really boosted household finances and things like that. But what I'm looking at here is just recently here in May, then the sector started underperforming again. Okay, you see this last red arrow down, where you had a pretty good gap there, a pretty good gap of about 5%, where the consumer discretionary stocks were actually outperforming the S&P 500, the broader market, and now it's come down. It's come down to about market perform there on that chart. So I think this is kind of a second opportunity, really, to be able to get into some of these stocks, because that I think could frankly do very well over the summer and really, even into next year, as far as into next year, and really start out outperforming. And what I'm looking at here is just the fact that, okay, Memorial Day weekend, this weekend, kind of unofficially starts the summer travel season, shopping. People are getting out of their house. We're seeing the COVID infections in the U.S. Are actually down to around 20,000 a day. It's lowest we've seen in more than a year. Outside the U.S. and Europe and other parts of the world, it's coming down as well. And so you get people coming out, going outside, and the infection rate's going to slow on that as well as just general spending. But households have over $2.3 billion in excess savings, and that's data according to Morgan Stanley. Okay, so savings in savings accounts that they surveyed across the U.S. $2.3 billion more than they would normally have, before pre-pandemic. And the savings rate is insane. Let's look at this another chart here that I picked up from the Federal Reserve. Puts this out, and this shows the savings rate, personal savings rate, and this is a percentage of like disposable income, right, that households have saved, and they release that each month. March, 27.6%. So more than one out of every $4 of disposable income was saved in that month. And of course, a lot of these, you've got these two really big bumps here in 2021. I think that was January, and this one was March, and that was because those stimulus checks went out, right? Households got a bunch of money in their bank accounts real quick from that stimulus check. They still really weren't spending it very much, so that savings rate went way up. But even if you look at just this long-term picture here, this is all the way from 2011, so the past 10 years. And you see, Americans, we love to spend our money, okay? We just can't resist living beyond our means and spending. So this typically was down under 5%, right? So typically, average U.S. household was saving less than 5% of their disposable income, in savings, investments, whatever. And just this last year and a half, it has boomed to that 27% increase. And it was even, throughout the pandemic, it was never under, like 12, 13%. So that's really where you get this $2.3 billion in excess savings that are just sitting in bank accounts out there, okay? The Afterpay, just this last week, the Afterpay CEO told Yahoo Finance that he had seen a surge away from credit cards into debit cards, right? So debit cards, just the stuff backed in your savings account, not credit spending, because people have all this cash, right? Household finances are just amazing. And I think consumers are really going to drive a shopping spree into the summer, and it's hard seeing them spend through all this money in just the summer. So that's why I think we could see higher consumer spending through the summer, even into fall, and it's going to be a very strong holiday spending season there. So what I want to do is kind of want to look at some of the other fundamentals of the sector there, the consumer discretionary sector. Then we'll look at kind of how to pick some of the stocks in there, some of them that are doing well, some of them that you might be able to look at. So I want to go over here to, and all you out there in the nation are going to recognize this. This is the FactSet Earnings Insight. Okay, they put this out, every Friday, or sometimes every two Fridays, when they're every other Friday when the earnings season is kind of wound down. So what we want to do here is I want to look at a couple of charts that shows you just how strong the consumer discretionary sector is, the stocks in that sector. And again, we're talking about retailers, apparel. We're talking about basically all those things that sell stuff that you don't have to buy, not the staples, that kind of thing. So first here we'll go to, and I've got in my notes. Okay, so here, this first one, this is the sector level earnings surprises for the first quarter. Okay, first quarter earnings just got wrapped up, right? Companies were reporting how much in sales and earnings they made over the last 3 months. Okay, and everyone beats earnings, right? Everyone almost always beats their earnings expectations because that's just the game they play on Wall Street, right? Analysts or management from companies. They try to kind of downgrade analyst estimates so they can surprise on the upside and make themselves look better come earnings. But it has very rarely been as good as it was last quarter. Okay, 86% of companies in the S&P 500 actually beat their earnings expectations over the last quarter. That's well above the average. And what's even more than that, the level at which they actually beat earnings expectations was huge. Okay, this shows for each of the sectors how much companies on average in that sector beat those expectations for earnings. And consumer discretionary tops the list at 57.3%. Okay, that means all the companies in the S&P 500 consumer discretionary sector, those retailers and whatnot, they beat their earnings expectations on average by 57%. Okay, so if they were expecting if analysts were expecting a company to post $100 in earnings per share, they ended up posting $157 in earnings per share. So it was an amazing quarter for the retailers, right? You can also look at on the on the earnings side. That was how much they beat earnings expectations. But now let's look at. Here we go. This is the actual earnings growth that was reported. Okay, and again, you can see, for each sector here, as well as the S&P 500 in the middle. But you see how well consumer discretionary actually did. Topped the list again, all 11 sectors. Right here, you've got the earnings growth for first quarter 2021. So this most recent earnings. Consumer discretionary stocks, companies in that sector posted 230% earnings growth versus the first quarter of last year. Now, granted, okay, obviously, first quarter of last year was horrible for consumer discretionary stocks, and it's going to be even worse. Q2, the obviously almost everything was shut down in the second quarter of last year. So that's why you get this 230% earnings growth, but it's still an amazing number. It's still to be able to double your earnings from the year over year really shows how far these companies have come. Versus for Q2, and they've got this that chart here as well, but I don't think we'll focus on that one. For Q2, they're expecting earnings for the consumer discretionary space to rise 175% over the last quarter. And here's that one. So earnings growth Q2 2021. So this next earnings season coming up. So you've got January, February, March is the first quarter. April, May, June is the second quarter. So we'll start getting those earnings reports in July, right? So some companies will start reporting that. And again here, they're expecting companies in the consumer discretionary space to post 175% earnings growth over the year, which is really an amazing rebound. One more chart I want to show you here, and then we'll get into how to look at these, how to look for stocks in this sector and how to look at this. But this is just the sector level bottom-up target prices from analysts versus the closing prices by sector again. And again, what you're looking at here is FactSet and polls and surveys all the analysts, right? The analysts, in a lot of the bulge bracket firms for their target prices on all the stocks in each of these sectors, and then compares it against the recent closing prices for all those stocks, right? So it kind of gives you an estimate for potential returns or expected returns in that sector over the next year. And here we go. Consumer discretionary leads the pack again. Of the 11 sectors, consumer discretionary is expected to post about a 21% return over the next year when you compare analyst target prices versus the closing prices, versus the most recent closing prices for those stocks. And you've got, you can look through these. Great resource, this FactSet Earnings Insight kind of gets you an idea of where earnings are, what analysts are expecting, things like that. You've got, information technology, about 20%, communication services, 19%. Analysts expect the S&P 500 as a whole to post about a 14% return over the next year. So pretty solid return expectations there. Whether you believe it's going to get there or not, that's just something you kind of have to work out with your own narrative, your own themes, and what you're looking at in the market. But again, analysts expecting consumer discretionary stocks, the stocks in that sector, to do better than any other sector over the next year. So again, I think if we look at that, we go back to that chart of the XLY, the Consumer Discretionary Fund, and here I'm not necessarily saying invest in that fund, but if you look at that as a whole, as a proxy for the sector, then you really do have a second opportunity here as those stocks pull back here in this last month. And I think a lot of this was just they had done so well. Investors were kind of profit taking a little bit. We're kind of getting a little bit nervous at if some of the earnings don't come back, or what if COVID comes back a little bit stronger or whatever. So a lot of these stocks sold off, and I think you've got a real opportunity here going forward. So what we'll do here is we'll use another resource that I like. And again, here this is this is the sector tracker, the Spider sector tracker. So you go to sectorspider.com. That's sectorspdr.com. And you'll see these tools across the top here, right? You go to tools, you can use the sector tracker, which is this first one that I'll show you, and then there's another one here is, the tools, you go to the sector tracker, and then you got the overview and the heat map that we'll both be using on those. So for the sector tracker, it's a great resource, kind of give you an overview of how the sectors are doing in these different time frames. And I really like to use this in our daily Bowtie newsletter we send out, just to kind of track those trends and things in the sector. And then we'll look at the heat map as well. But if you see the consumer discretionary sector year to date, so from January of this year has done 7.5%, right? And that's actually underperformed the S&P 500 for the year, and it's because the pullback in March when we saw a lot of the lockdowns reoccurring in in Europe and other parts of the world, as well as those higher interest rates in February, as well as just the recent pullback in the sector as well. And you can look through here, over the past 5 days, over the past month, but let's just keep it on 1 year. And here in the right, you can actually see there's about 100, actually about 80 companies, maybe a little bit less, 80 companies in the S&P 500 in this sector. Okay, and what you'll see here is just a list of all the companies, and we'll look at the industries, kind of give you an idea of how to narrow it down even further from there. But you can see a lot of these L brands, 87% so far this year, Gap, 65%. So what we're seeing is a lot of the apparel retailers bounce back, doing very well. Obviously, people didn't need to refresh their wardrobe, their closet last year, beyond just flip-flops and a t-shirt. So you've got people getting out and refreshing their wardrobe this year. You've got the major automakers, Ford and GM, are both within the top 10 here. They're doing very well on those, on the movement or the progress into electric vehicles. Kind of disconnected from this theme that we're talking about here, but also doing very well. You see some of the gambling stocks, Caesars. You've got MGM Resorts, things like that are doing well. Obviously, on that return to gambling, I think Las Vegas was operating at 50% capacity, but just recently the governor there said that they could open up full capacity here within late June, maybe June 19th, I think is what they said. So full capacity in Vegas now within the next few weeks, and obviously that's driving a lot of those stocks there. So you can kind of just look through here, and what I like to do a lot of times is also just look at the laggards in the sector to kind of give me an idea of what themes aren't playing out in the sector, or where might be some value still left. Okay, we've got Tesla there, and I think when we look at the automakers, so Tesla, GM, and Ford, that's kind of disconnected again from what we're talking about, from this reopening, consumer spending theme, because a lot of it is, that broader electric vehicle kind of ideas. So kind of unrelated there. But if you look at some of these others, Dollar Tree, if you look at Dollar General, TJX companies, a lot of these off-brand, you've got Ross stores here, a lot of these off-brand or discount stores, discount apparel, obviously not doing as well. And I think this is a really interesting thing to look at is, we've got that $2.3 billion in excess savings, all those zeros in people's bank accounts, right, in those savings. And I think people are actually going to be spending on those higher priced items, right? The vacations, the expensive vacations, the luxury things, even luxury cars. the things that maybe they always wanted to spend on, but they didn't quite have the money, right? So you start seeing more zeros in your bank account. You start thinking about those higher price things that you always wanted to buy, right? You're buying Tiffany instead of, well, I almost said Kmart, but I don't even know if we still even have Kmart. No, we don't. But Target, okay? Target's doing very well, but some of these other off-price discount and cheaper stores like Ross and like TJX companies, things like that, aren't doing quite as well because people are spending up. So I would look at a little bit higher price, higher margin, luxury stuff rather than some of these names. You've also got obviously Etsy is in there. You've got some of the Amazon is actually down for the year so far, and it's obviously because these companies, internet retail companies, did so well last year that they're not doing quite as well this year, and really not benefiting from this trend, this consumer spending trend to really get out. So you can use that. Now I want to look at the heat map though, and this is interesting. Actually, I already have that up in this one. And if you go to the heat map, this just shows you kind of a color-coded scale of the same thing that tracker does. But you can also go into each one and you look at it on this way. And I think, again, this just gives you a better idea to spot some of the themes and the trends. Okay, so if you look at the pink are actually ones that have underperformed. So you've got you got Dollar Tree, you got Dollar General. So we're talking about those discount stores that people have the money. So why not spend it somewhere a little bit nicer? Not saying that Dollar General isn't nice. I've shopped there in the past myself. TJX, a lot of their clothing is goes to that this discount brand stores. You've got Ross in there, things like that. VFC. Now, that's interesting, though, that Nike hasn't done very well this year because I would think that Nike would do well, in that consumer spending and that reopening trend, especially, athletics, athletic wear and sports, things like that have done very well. So I would actually think Nike should do well here as this theme develops. I like Nike there. You've also got obviously some of these the internet retail. So Amazon and Etsy have underperformed. Here's Etsy here in pink. Not benefiting as much from that traditional return to shopping, that traditional shopping that people get out in brick and mortars. Some of the outperformers, that luxury and higher margin retail, I think would be a good target here. L Brands, like we've seen, that's already up 80%. So that one might be a little bit expensive here. I think TPR, so Tapestry, they see if we can find that here. So Tapestry is up 44% so far this year. Not quite as much. So L Brands here towards the bottom, we see L Brands up 87%. Tapestry is up 44%. Tapestry does a lot of, I think they own Coach. So the Coach brands of accessories, things like that. So some of that luxury, higher margin retail than some of these other discount retailers. So again, I think that's really where you want to look. You want to look for value in those as people see more zeros in their bank account. You've also got travel, anything related to travel. Again, it's surged recently with the casinos, bookings.com. The hotels have done really well. But I think, again, as you see people's spending habits reemerge and really what people have been missing. Okay, I think people have really been missing those vacations. They feel like it's been an eternity since they've had a vacation last, and they're going to splurge. Okay, they're going to go to Vegas. They're going to go to stay in these hotels, and that's really going to help. I think the TW or the TSA reported that they're seeing an average of about 2 million passengers booked through TSA checkpoints each day over the weekend, over the holiday weekend here, which is back to pre-pandemic levels, doing very well. So domestic travel back up to almost pre-pandemic levels. Actually, is about 90% of where we were before the virus. Now, what you have to understand here, so you're looking at travel, so you're looking at airlines, looking at hotels, some of those travel-related themes, is that international travel and business travel is still nowhere near where it was, and probably won't for a very long time. Okay, obviously international travel, borders are still locked down, trying to keep keep that virus from spreading internationally. Business travel is still very much lower. So you want to be focusing on stocks within that travel component that are more geared towards domestic travel and retail, retail travel, not business travel. So you've got casinos, you've got maybe some of the travel sites that are a little bit more focused towards vacation planning, things like that, as well as hotels and resorts. In fact, so just kind of an idea of what to be looking for in the consumer discretionary space. Again, it's just amazing the amount of money that has been pumped into the system and has not been spent. Okay, the between the Fed and the federal government, so the Federal Reserve and the federal government, they pumped about more than $10 trillion into the economy, which you look at a $24 trillion economy like the US, that's almost 50%. That's almost half the entire economy, the GDP pretty much forced into the economy. And nobody was able to spend it, right? So, you get all these economists talking about there's no inflation because the money supply isn't generated or isn't being turned over. Well, duh, people have been trapped in their house. They haven't been able to spend it. This is the unofficial start to summer. People getting out, traveling, and spending their money and spending that $2.3 trillion. So I think this is one of the major themes that you want to be looking for over the summer, even over into as far as into next year. Looking into these themes again. Look at the travel related themes that are not quite focused on business or international travel. So you want those domestic travel names. You want luxury names, luxury brands and maybe a little bit higher margin brands rather than discount or, some of the cheaper retailers because, people are spending more, they have more money and they're going to spend it on higher priced luxury stuff. I want to open it up to a question and answer session.